Hello and welcome to part two of the Q&A series. I guess it's going to be a series. So I'm here with my university friend Harris, and we're just going through some beginner questions, what a beginner might want to know when they start investing or trading. And so we'll just carry on from where we left off and dive straight into it. So if you just want to fire off your next question.
Right. So for the first question in the second half is what are index funds?
So an index fund is like an exchange traded fund, so ETFs. So you have like the Vanguard S&P 500, which is this. And so what this does is it tracks the 500 biggest companies in the United States. Oh, let me see how I do this. Ah, I get it now. So
ETFs are the same as index funds. Or are they different?
they're the same, I think. They're the same. So I'm pretty sure they're the same. Let me see, an index fund. Yeah, or an exchange traded fund. So yeah, they're the same.
Oh, right.
So this, for example, the Vanguard S&P 500 tracks the 500 biggest companies in the United States. So it tracks the American economy basically.
Right.
And the good thing with an ETF is it can't go bust, because for the ETF to go bust, like the country would have to disappear basically.
Yeah, I get what you mean.
So it's
It's
quite a
500
safe.
companies that you basically invest in.
Exactly. And according to the efficient market hypothesis, according to the efficient market hypothesis, you can't outperform this, right?
Right.
According to the efficient market hypothesis, if you get anything, so say for example, if you watch my mouse, say for example, if you had anything that tracked a line like this, that was above the blue line,
Yeah.
then you've just been lucky, basically. That's it. You've just been lucky, and eventually your luck will run out.
Right.
Um,
So if
so
you're saying that you can never, so it never goes bust, basically, would that not mean then, oh, why do I just put all my money into this then, or
exactly. So this is what the efficient market hypothesis says,
yeah,
is that you can't beat the market, so you may as well just invest in something that follows the market,
right,
right? And
right,
as a beginner investor, I would recommend just investing in an ETF, because say for example, if you just invested in the S&P 500 ETF, right, over the
mm,
past, I don't know, let's just say 20 years. So say for
mm,
example, if you put in, say for example, if you put in, let's find a date here. So say for example, um, what's this date here? So, 30, so let's say yeah. So January 2018, if you
mm,
invested £35, right,
yeah,
by today you would have £47, right,
yeah,
which is a lot more than you'd have made if you put it in the bank, because the bank interest rate's like less than 1%.
yeah,
So as a beginner investor, you may as well just invest maybe not like all of your money, because you need cash for liquidity. Like liquidity is just spare cash when you need it.
right,
So so as a beginner investor, you're definitely better off investing some of your money in an ETF rather than having it all in the bank account, because it's wasted money, especially if you're not spending it.
right,
And as a beginner investor, you're very unlikely to beat the market as well. So you may as well just follow the market.
right, yeah,
And like, so the S&P 500 is like the American economy. If you want to hedge your risk even further, say for example, like, I don't know, Yellowstone erupted in America and like messed the country up. Like, there's also the All World Index, which tracks the biggest companies in the world,
yeah.
and it's quite similar to the S&P. This one minute, this one looks like quite a new ETF. Let me see. What about this one? Yeah, so this one's an older one. So 1 week. Or have I clicked on the same one? Let's see what other ones there are. Let's try this one. Right, this one looks a bit better. Mm, let me see. Right, well, it's not going as far back as I'd like, but as you can see, it basically this one tracks the world economy.
Yeah,
So this is like a really safe investment because the world economy is never going to go bust, but it will fluctuate up and down, so you need to make sure you have spare cash.
yeah,
Whereas if you're trading, you want to ensure that you have a very little drawdown so that you can use leverage to increase your gains. And also when you're trading, you're not just betting on the market going up, you're also trying to make money when the market goes down as well. So you basically, with investing, you're making money from the market going up, whereas
yeah.
trading, you're making money from the market being volatile.
Right.
And there's different types of index funds. So there's emerging markets,
Mm.
there's clean energy, which I'd recommend investing in. I think after this coronavirus, green energy is going to be a big thing. Um, you can do properties. You can do like
Is that basically another form of obviously investing in real estate and just doing it in an ETF?
yeah, basically yeah. So rather than buying a house, you can
Yeah.
invest in a property ETF,
Right.
and you basically make money from the properties going up in value. You get a dividend from the rents, and you don't have to worry about bad tenants that that are trashing the property. You can because you've just invested, and you can invest in commodities like gold. You have gold ETFs, you have bond ETFs. So basically, you can basically invest 80% in a share ETF, 20% in a bond ETF. You know,
Yeah.
spread your risk into different ETFs so you're diversified,
Definitely.
and that's a good way to invest by just using ETFs. Some in a shares ETF, some in a bond ETF, some in a gold ETF, and then rebalancing your portfolio a couple of times a year. So, for example, right now you'd want to be heavy. Well, maybe not so much now because the S&P is back to nearly its previous levels. But during
Yeah.
the COVID crisis, like the
Yeah.
main part of the crisis here, you would have wanted to be heavily invested in stocks because it
Yeah.
was so cheap. And look at how much it had left to go up.
Prices. Yeah.
Whereas here, you would have been like, we're in a boom, everything's going really, really well. So you would have wanted to invest more into gold
Yeah.
because when things are going really, really well, that's usually when the crash happens.
Right.
So the crash usually happens when things are going really well. So for example, in 2007, nobody saw the crash coming because things were going so well. So whenever things are going really, really well,
Then the
start
recession started.
well, just start taking things with a pinch of salt and start investing in gold and
Yeah.
having some spare cash there for when the recession comes because for every year since the recession's happened, another recession becomes more and more likely. Do you know
Right.
what I mean?
Yeah. No. Definitely.
So there's some hedge fund managers who they'll
Yeah.
look at history
Mm.
and they'll say whenever a stock's at a certain price, there's a something percent chance of a recession. If you
Yeah.
wanted to learn more about that, there's a YouTube channel called Real Vision which talks about this.
Yeah.
Um, so so yeah, that's that. So what's the next question you've got?
Let's see. So next. So I've written. I see people talk about growth funds. What are growth funds? Examples of some. Is it best to invest more into growth funds? Considering that we'll be getting a faster and larger return, or can it also be just as riskier to do so?
So if you're a younger person, you will want to invest in growth funds because you're trying to build your capital. Whereas if you're an older person, you'd want more money in cash and bonds because you're
Yeah.
trying to preserve your capital. So it's all about your risk tolerance. Because growth funds are more risky because they're investing in like startups and smaller companies.
Yeah.
Um, but Yeah, so for like examples of growth funds, like on Hargreaves Lansdown, they're probably the best place to invest in, like if you want to invest in a fund.
Yeah,
So yeah, you can invest in all different types of funds on there. Managed funds where like there's actually a manager who's managing it, whereas like ETFs just track the economy,
yeah,
whereas like a managed fund, someone's actually managing it for you. But
yeah,
there's a management fee as well then. But I'd probably say yeah, have some growth funds in there. I'd probably say growth funds are cyclical. What would it be called? Pro-cyclical. So I would expect that growth funds would be hit the worst in a recession,
yeah.
and
Okay, yeah.
and like the big companies would probably be a bit safer, like tech companies, etc.
Mm.
Um, but definitely have growth funds in there to diversify. Would
Yeah.
definitely say that. Um,
Is there
yeah,
any some examples of growth funds that you've invested in, or
on my Hargreaves Lansdowne, I'll have a look on my phone now, and what I'll do is I'll pause the video whilst I do it.
yeah,
Right, so I was just looking at my Hargreaves Lansdowne, and I think with growth funds as well is they reinvest the dividends. So so they're reinvesting. So whenever they paid a dividend, they use the dividend payments to buy more stocks.
yeah,
Do you understand what I mean? But what I'll do is I'll actually Google growth fund so we can actually get a better definition for it. So growth fund definition, Investopedia. A growth fund is a diversified portfolio of stocks that has capital appreciation as its primary goal, with little or no dividend payouts. Yeah, so they're not paying you dividends, they're reinvesting the dividends. So you're not getting income, you're just increasing your wealth, basically.
right,
So like as long as you're not bothered about and the dividend, you would invest in growth funds. Probably just invest in them alongside income funds
right.
just to diversify, I would say. And in
Mm.
terms of the type of funds on my Hargreaves Lansdowne, I'll just read a few because they have some really interesting ones.
Are
So
these ones that you've invested in already, or?
yeah, so there's
Alright,
like biotech. I've invested in a biotech fund, an artificial intelligence fund, fintech fund, health fund, clean economy fund, longevity fund, robotech fund, future technology fund, nutrition fund, um, Sustainable Water and Waste Fund. What else? What else? Life Sciences Fund, Financial Opportunities Fund, Sustainable Energies Fund, Intrinsic Value Fund, Asia Future Leaders Fund. So these are like I'm trying to be on the precipice of what the new things are going to be. You know what to be invested in now.
right.
Um, so that's the different funds. So does that answer the question around growth funds and
Yeah,
different funds in general?
yeah, that sounds good. I was gonna say as well, in that screenshot, not screenshot, but your screen, where it says, where you said that they reinvest the dividend fund anyways, in the growth fund.
What do you mean?
Did you say that in a growth fund, because it says there's little or no dividend payouts, that they reinvest the dividend?
Yeah.
Alright, so would that take out the question of, oh, well, actually, I'm gonna come, should I come to that dividend question now then?
Yeah, yeah, sure, yeah.
So it's kind of answering this question at the same time. That's why I feel like it's easier to mention now. So I was going to say, can you explain dividend stocks? Are a company's dividend payout payments enough reason to buy their stock? So I know some people are really reliant on which company they invest in because they look at their dividend payments and stuff. So
I wouldn't just look at the dividend payments alone. Um, I would look at like the fundamentals of the company. Is the company doing well? What are its growth opportunities? What are the directors doing? What are the technicals looking like? The dividends are good. Like for example, if a company has a history of paying its dividends even in a recession,
yeah,
that's good. And the good thing is if with stocks, like invested in stocks rather than gold,
mm,
is that if gold loses its value, it loses its value. Whereas if stocks lose their value, you still get paid a dividend.
right,
So you will still earn a dividend even if it loses its value. So sometimes, like say for example, you had a good stock and it lost all of its value and you're thinking of selling it, but it still pays a good dividend, then really you might not even need to sell it because you still get the dividend. So that's the good thing about stocks as opposed to other things is you still get paid the dividend, but I wouldn't just look at the dividend alone. You
Yeah.
would want to look at all of the different positives and all of the different negatives of the company
Yeah.
and then come to a decision. And if possible, come to a decision with a consensus view. So ask other people their views because
Yeah.
like you're just an echo chamber. Ask other people their views and ask people from a diverse range of backgrounds and expertise.
Yeah.
Like ask it like this is the good thing about like be like if you work for an elite company, there'll be
Yeah.
people from different backgrounds, there'll be people from accountancy, people from marketing, people from business, and and asking other experts also helps with coming to your final view. And there's actually groups that you can join. So there's one in Manchester called the Serious Investors Group Network, where
Yeah.
people will actually talk about their investments, and this all helps make your final decision on whether to buy a stock.
Right. Yeah, I get what you mean.
Yeah.
So when you get a dividend payment, then you, I don't know if you've had the experience with, or well, if you've invested in stocks that pay a dividend, what do you typically tend on doing? Do you reinvest that back in, or do you keep the dividend payment?
I'll invest that back in. I think it was Warren Buffett said that what is it? Compound growth is the eighth wonder of the universe. So so if you reinvest your income,
Yeah.
this is what it looks like, right? This is what your income does if you reinvest it. It's exponential growth. So so you start off with a little at first, and then
Yeah.
as long as you keep reinvesting the income, you then get a compound exponential growth.
Yeah.
So it's actually the best way to become like this is how millionaires become billionaires so quick.
Mm.
Like one day you're a millionaire, the next you're a billionaire because of compound growth. And so it's always best to reinvest your income because this is what you want your this is how you want your wealth to look like. This is
Yeah.
what I mean over
So,
time. Because for example, if you just invest in a bank account, it's going to look more like this linear growth. So it's going to look more like linear growth, and it's actually all of these curves are too steep. So there we go. This is exponential versus linear growth. So what would you rather have? Do you know what I
yeah.
mean?
Yeah. Yeah.
So yeah. So I'm on 18 minutes. So we'll try and get through another question quickly, shall we?
Yeah. It can be the last. I think we're on one more now. So
Okay.
that is final question. Oh, well, there's actually two, but I guess you can answer them both really
We'll
quickly.
do them in the next video then, shall we?
I'll do one more then.
Yeah. We'll do one more video.
I'll do a small one now then. For a beginner like myself, how much would you recommend we put into invest amount wise? How much money shall I put into invest as a beginner?
I'd say
How
start.
much?
What?
And then it follows with like how much you started with as a
I'd probably say start with a practice account, paper trade with money that isn't real.
yeah.
And once you're comfortable with that, start off with a small amount of money and then drip feed it in. So maybe put in, I don't know, 20, 20 quid a week. Don't put all of your money in at once. Drip feed it in £20 a week into an ETF. And then as you get more confident, start doing individual stocks, doing your analysis. And then as you get more confident, then start getting into the trading, start short selling and start building up from there. Start with a
Yeah.
practice account, then move into ETFs. Don't put all of your money in at once. Drip feed it. Spread your risk over time.
Yeah.
And yeah, that's what I would say. And then build on it from there.
Yeah. I think that's answered it.
So is that everything?
Yeah. For this part anyways, yeah.
Okay, thank you everyone for watching this video. Is there going to be a part 3?
I guess I could ask you. It's only one question, but we'll probably ask it off camera anyways.
Right, okay. All right. Well, thank you for watching this episode, guys, and I'll see you in the next one. Cheers. Bye for now.